For employers who provide health insurance, this short presentation will provide a clear understanding of how best to finance healthcare. Specifically, how a health savings account could be the best possible solution for you, your employees, and their family members. The financing method that we use to purchase healthcare has as much influence as the people engaged in delivering artful medicine. Health savings accounts have been around since 2004. However, many people wonder if it's useful to their own personal situation. Most of us have predictable visits to the doctor, checkups, or other healthcare needs in any given year. For these, we need less insurance and more of a budget. Costing perhaps hundreds of dollars, these are, for most of us, affordable, less expensive, and reasonable services associated with everyday life. Then, perhaps less predictable and moderately more expensive are those medical needs, unexpected sickness, injury, or surgery costing thousands of dollars, that may not bankrupt us, but could prove difficult to afford or be very inconvenient to our budgets. Finally, there are those expensive medical services that are more catastrophic in nature and cost tens of thousands of dollars. For many of us, these threaten our financial security. Before health insurance, most people paid cash for all their medical care. Physicians and hospitals were paid what people could afford and what charities would allow. When World War II began, the federal government mandated a wage freeze. Factories offered health care benefits in lieu of wage increases to attract workers. And employer-sponsored health plans were born. Later, special interest groups introduced legislation for the preferential tax treatment of insurance, the premiums and benefits, solidifying our third-party payment system, or what we call the traditional health insurance plan. This traditional health plan grew in popularity, and laws encouraged its growth. In most cases, insurance premiums and benefits are both paid tax-free. We minimize our tax liability when we finance our health care through insurance. There is simply nothing else like it, and we all take it for granted. It's how we expect to purchase our health care. In 1974, the federal government sponsored the single largest and most important health insurance experiment in history, the RAND Health Insurance Experiment. In today's dollars, it was a $295 million experiment that randomly assigned about 6,000 individuals different levels of out-of-pocket cost sharing, from free care to large deductibles as high as $4,000. What we learned was that except for the indigent, the health of most individuals did not suffer from larger out-of-pocket costs. In fact, in most cases, health outcomes and purchasing decisions improved with higher out-of-pocket costs. So, it made sense to budget for out-of-pocket expenses using higher deductibles in order to lower our premiums. Not so fast. Remember the preferential tax treatment for health insurance plans? For most of us, it didn't make sense to trade a tax-free health insurance premium payment for a higher deductible that has to be paid for with after-tax dollars. No matter how sound the RAND health insurance experiment was, the growth of higher deductible plans was slow. Our tax code just did not support it. Traditional health insurance plans remained unchallenged for 30 years. Then, effective January 1, 2004, the Bush administration passed a law that included something called health savings accounts that worked well with high deductible health plans. Now, through an MHSA, a high deductible can be financed with pre-tax dollars, similar to the preferential tax treatment previously reserved for insurance companies. Individuals keep their money in an MHSA year after year, instead of spending it all on insurance premiums. This is how it works. The individual purchases less insurance from the insurance company by way of an HDHP, thereby lowering their premium. They divert those savings into an MHSA. If they ever need to spend the money on qualified medical care, it's there, ready to be spent tax-free. Unlike health insurance, whatever you do not spend stays in your HSA, earning interest as a personal asset. As long as you pay your premium, the HDHP remains as your financial safeguard against higher medical expenses. This is public policy that better supports what we learned from the RAND health insurance experiment. And nearly 14 million people now have an HSA. There are pros and cons with health savings accounts. If you're considering whether or not a health savings account is right for your company, rely on Cosby Insurance Group to help you make the best, most informed decision. Call us or visit us online.